And we still have Jeffrey Gundlach, obviously, with us. And Jeffrey, I hope you'll oblige us here. You know, Steve has what I think is a good question for you as you talk about the yield curve still being inverted. Steve, you want to ask Jeffrey what I know is on your mind?
Well, the reason why it's on my mind, because I just talked about this idea, Jeff, which I'm sure is on your mind, this idea of steady rate cuts on the short end. Jeff, how does the curve, or does the curve, disinvert in that process?
Well, I think short rates fall. 2-year Treasury rates fall, 3-year Treasury rates fall, 5-year Treasury rates fall. And the further you go out the curve, the less they're going to fall. I thought Steve's question to Jay was really good. It actually jogged my thinking about how much room he has to cut, because Steve asked, is it one cut or is it a normalization process? And I don't know if Jay kept that question in his mind as he continued after Steve's question, but he seemed to, if I try to read the tea leaves, it seems to me that Jay Powell's answer was normalizing. I think he knows that the path of inflation is likely lower in the near term. One thing that he did speak to was the seasonality of inflation, and I think that's a bigger point than most people appreciate. The first quarter, even though these numbers are seasonally adjusted, and Jay pointed that out, even though they're seasonally adjusted, there's this bizarre pattern that is quite strongly in place for multiple years, that the first quarter comes out hot, and then the second half of the year comes out cool. And so we have a couple of PCE headline numbers, not the one coming up, but the two after that. The ones that are rolling off are 0.4. It seems unlikely to me that you're going to get 0.4 replacing them. So we still have downward momentum likely on that headline inflation, and it's further supported by the uncanny seasonals that seem to be in place, that the fourth quarter inflation is less than the first quarter, and certainly the second half is less than the first half. So these are further things that support the notion of cutting interest rates. Jay's right to say we don't know what the date is going to be. Just like I loved his answer when he said, I don't know who's going to win the election. It would be ridiculous to try to factor one party's policies versus another. You don't even know who's going to win. But I do think that these things, the seasonality of inflation is important and will be further supportive of the Fed cutting rates. I expect the Fed is going to cut rates in line with what the market is predicting. And if I had to take an under and over, I would think the Fed's going to cut rates more than the market thinks over the next. I think we have 150 basis points of cuts coming, but certainly by a year from now. It's interesting that the Fed hasn't touched the Fed funds rate over the past year, and markets since the last Fed meeting are virtually unchanged. There's almost no changes anywhere. So the market seems to have settled in and is waiting for the cutting cycle to begin, and I think they're going to get rewarded with that.
Interesting. Steve Leisman, thank you, as always, of course, for joining us after leaving the room with the Fed chair. So, Jeffrey, you've been pretty explicit as well in calling for a recession. Every time we've been speaking and having these conversations, the Fed chair today, as you alluded to earlier, said he thinks we're well positioned. He likes where we are. The chances of a hard landing, he said, quote, I think they're low. Has your own view changed?
No, I have the same view. I think when we look back at what, today, and it'll be history when we look back at it a couple of years from now, I kind of believe that we will say that we were in a recession in September of 2024.
Interesting. Because, he still thinks that the economy, obviously, is doing pretty well. Yes, there are some spots of weakness, said the Fed chair, but overall is good. You take issue with that, too, based on what you've been hearing from CEOs about the consumer?
I think it has to do with a lot of anecdotal evidence and a lot of the, if you just don't look at one data point, like the establishment unemployment rate survey, there's a lot of things around that are not nearly as encouraging. I talked about the quits rate is way down. Even leisure and hospitality, the unemployment rate is rising. Unemployment claims are rising. The full-time employment is being supplemented by part-time employment. Some people are working a full-time job and a part-time job. They're counted as two jobs, but that's just one person who's trying to keep their head above the inflation waters. So I just feel that I hear a lot of people anecdotally that talk about I lost my job. I can't find a new one. One guy, I don't know, they're just anecdotes, but I was working in the same industry for 10 years, and my company had to close down. I lost my job, and I'm applying every week, sometimes 2 jobs a week, and nobody hires me. I can't get a job. That's starting to happen. So employment is a lagging indicator. Everybody knows that. But the trend in employment has already changed for the worse. So, and it's masked, I'll say it one more time, the government hiring is a little bit curious. If you want to make your data better, you can manipulate it by having your area of the economy do some extra hiring. And that appears to be what's happening. Government employment was on a downtrend, flattened out, and now it's been rising. Well, so I don't think the economy is that strong, Scott.